Good morning, guys. Welcome to Mug Briefing. News broke today that Meta may be preparing for another large wave of layoffs. But here's the first thing to understand. Nothing has actually been approved yet. According to reporting, senior leaders inside Meta were told to prepare plans that could potentially cut around 20% of the company's workforce. The company currently has about 79,000 employees, which means a cut of that size could affect roughly 15,800 people. But that number is not confirmed internally as a final decision. It's a planning scenario. And that distinction matters. Managers were reportedly asked to model what reductions might look like, not to execute them immediately. Meta itself called the report speculative, so financially speaking, nothing has actually changed yet on the company's books. Yesterday, Meta still had the same workforce. Today, it still does. What changed is the possibility of a major restructuring, and markets react quickly to that kind of signal. The stock of Meta platforms slipped after the report circulated, not because layoffs themselves damage profits. Layoffs often increase profits, but because investors suddenly had new uncertainty to process. Here's where it gets interesting. Meta is currently spending enormous amounts of money on artificial intelligence infrastructure. The company reported about $117.69 billion in total costs and expenses for 2025, and around $72.22 billion in capital spending, mostly tied to data centers and computing capacity. That's the hardware side of AI: massive server farms, advanced chips, huge electricity demand. But people often assume payroll is the biggest corporate cost. At a company like Meta, it's actually only one part of the picture. Even if Meta cut 20% of employees, the estimated annual savings might be around $3.1 to $4.7 billion, depending on the average cost per employee. That estimate assumes roughly $200,000 to $300,000 per worker per year, including salary, benefits, and stock compensation. Put that into perspective. Meta's yearly costs are over $117 billion, so even aggressive layoffs would only move the total cost structure by a few percentage points. And this is why the story is more complicated than just cutting expenses, because layoffs would not meaningfully offset the scale of Meta's AI spending. The company's capital spending, building AI infrastructure, is already tens of billions of dollars per year, and management has talked about plans to invest hundreds of billions of dollars into U.S. infrastructure and data centers over time, figures that have been reported in industry coverage tied to Meta's long-term AI ambitions. So the real question investors are asking isn't simply, are layoffs coming? The deeper question is why the company might want them. One interpretation is margin protection. Margins are basically how much profit a company keeps after paying its costs. If Meta reduces headcount, operating expenses fall, which can boost margins once the dust settles. But that's only part of it. Another possibility is that Meta wants to redirect money toward AI development. Instead of expanding headcount across the organization, management may prefer investing more heavily in computing infrastructure, machine learning models, and specialized engineering teams. In other words, fewer employees overall, but far more computing power. Now, zoom out for a second. This is actually part of a broader pattern across the tech industry. Companies are pouring massive capital into AI systems while simultaneously trying to run leaner workforces. Earlier layoffs across the sector from companies like Amazon, Atlassian, and Block reflected a similar balancing act: spend heavily on technology, control operating costs elsewhere. But this strategy creates a new tension. If layoffs go too far, they risk cutting into the very teams responsible for building the next generation of products. At Meta, that could include engineers developing AI tools that improve the advertising platform, which is still the company's main source of revenue. And if innovation slows, the long-term revenue growth story could weaken. So investors are weighing two very different outcomes. On one side, layoffs could eventually increase earnings. Labor savings flow into operating profit once the severance costs pass through. With Meta's roughly 3 billion shares outstanding, the theoretical savings from a 20% workforce reduction might translate to roughly $1 to $1.5 of additional earnings per share over time, before taxes and restructuring costs. But here's the catch. The first year might look very different. Large layoffs usually come with severance packages, contract termination costs, and restructuring charges. Those expenses hit immediately, which means the short-term financial benefit can be much smaller than the long-term savings. And until the company actually announces details, nobody knows how large those charges might be. That uncertainty is part of what pushed the stock lower today. Investors aren't reacting purely to layoffs. They're reacting to what the layoffs might signal. Are they a sign of cost discipline, or a signal that AI spending is becoming so large the company needs to cut elsewhere? Another layer here involves the broader market. Meta is one of the largest companies in major U.S. stock indexes. It makes up roughly 3 to 4% of the Nasdaq-focused ETF QQQ and around 2 to 3% of the S&P 500, which means when the stock moves sharply, millions of retirement accounts and index investors feel it indirectly, even if they never bought the stock directly. And there's another ripple effect. If Meta eventually cuts engineering roles, competitors could gain talent. Companies like Google, Microsoft, and AI-focused startups are constantly looking for experienced engineers. Layoffs in one company often become hiring opportunities somewhere else. But right now, none of that has happened yet. No layoffs have been formally announced, no restructuring charges have been disclosed, and no teams have been identified. Everything comes from early planning discussions reported by Reuters. So the story today is not about confirmed cuts. It's about the possibility of a major strategic shift, a company investing heavily in artificial intelligence infrastructure while trying to run a tighter organization at the same time. And the next few weeks will likely determine whether this becomes another efficiency round, something the tech industry has seen before, or the beginning of a deeper transformation, where big tech companies rely less on large employee bases and more on massive computing power. Because if internal planning turns into an official announcement, analysts will start revising earnings models, investors will reassess Meta's growth trajectory, and attention will quickly shift to one key question: not whether layoffs are happening, but whether they help Meta win the race to build the future of artificial intelligence.